Welcome to the Dakota Housing Network. This is Joe Sheehan.
Dave Floor.
We don't have monikers anymore. Remember, we used to be the body built for radio. Well, we can't. Neither one of us can say that. Look at you over there, Slim Jim.
Yeah, we're looking good.
You're body built for your living room.
Yep. Well, it still is. It's not that good. It's not that good, Joe.
Well, yeah, but what you got over there, man, is you're working on the new in thing, the dad bod.
Yeah.
Everybody wants the dad bod now. Nobody wants that chiseled model GQ look anymore.
Well, I'd go for how Cam Newton looks. He's a big dude. He's a big, strong dude.
Those guys look beastly, and I would not want to be Denver.
Can you imagine trying to tackle Cam Newton?
I can
say, okay, let's tackle this guy. That's all you got to do.
I could imagine tackling a 6-year-old Cam Newton.
Yeah,
and that would probably be more than I would want to. Yeah. That I would want to take on.
Peyton Manning, I'd take a shot at.
Peyton Manning,
I might be able to catch him.
You just sing that little song to him, and tackle him.
Stay put right now.
I'm going to tackle you.
I think we could do that.
All right.
And our guest on the radio is going, what am I in for?
He's he's so toast.
Yeah. I'm listening right now, and I'm thinking, well, you got your own Carson Wentz. I mean, he's 6'5" and he's 233. He's only a couple of pounds lighter than Cam.
Well, he's a Bismarck guy too.
Yeah, exactly.
Bismarck guy with mortgage roots.
Yeah,
so
that's right.
Yeah, one of his dad's ads might be running during the break. Who knows?
Yeah, never know
on the show. So
that's right.
Anyway, so that's Scott Woodruff with us, and he's with Radian Mortgage Insurance. He's going to be our special guest today when we get through the interest rate segment and the financial. We're going to bring Scott's going to talk about a subject we hate to talk about the most.
Oh, yeah.
We hate PMI.
Yeah.
Who doesn't hate PMI?
Scott Woodruff.
there's some things that are straight from the devil. Bacon's one. Bacon's from the devil.
It tastes so good.
And PMI.
PMI. Scott, you're going to refute that today, aren't you?
I'm going to try like heck.
Okay.
All right. So let's go ahead and let's talk about what interest rates are supposed to do and what they're going to do. Fed came out yesterday.
Oh boy, that was.
Boy, did she say nothing.
Man.
And
just move the markets.
The analysis out there, of course, is that unless they have strong jobs and strong inflation, March is going to be a non-event. We won't see anything happen.
They said there was global turmoil.
Ha! Imagine that.
There's
global turmoil?
I think that's every day.
That's
isn't it?
that's
There's
new.
Global turmoil somewhere.
I would the day. Here's the thing, that the day that we wake up and hold hands and hum feelings, that's going to be a bad day. Yeah. But currently, mortgage rates have really benefited from the global turmoil.
Yes,
and they've been improving.
And the Fed raising the overnight rate, they've benefited from that.
As we've said, again, one of the instances where we're probably right. The Freddie Mac Primary Mortgage Market Survey for January 28, 2016, 30-year fixed rate mortgage, 3.79 with 0.6 discount.
That sounds good to
me.
The
15-year fixed rate mortgage, 3.07, flirting with 2.
Okay, there we go.
Flirting with the 2s with a half-point discount. And so that is down from last week. And let's go ahead and go to the Mortgage Market Guide and see what do
those folks say today?
What do they say? Well, let's get to the primary. What did Barry? Did you read? Did you read Habib today?
I didn't get the Barry today.
We had a meeting,
so.
What's going on with that?
Meetings at the house. We're redoing our loan servicing system, so it was internal.
Meeting at
what do we do?
Yeah. Meeting at the Housing Finance Agency. Oh, by the way, we should make sure that before we get out of today, that we talk about the housing conference coming up.
Yeah, where Scott's going to be there.
Yep, he's
with a trainer.
Absolutely.
Yeah, you guys are sponsors. You're bringing in trainers and
so
we'll the whole bit.
Yep.
So the timing couldn't be more perfect. Okay, so still losing the battle at resistance. So rates should be better than they even are.
Oh my, really?
But they can't muster the battle. They got McClellan at the helm. So mortgage bonds.
Civil War, right?
Oh, yeah. Mortgage bonds are near unchanged, well off their highs, and the chart is showing an ugly candle. Beware.
Ooh, ugly
Yesterday, as expected, the Fed left interest rates on hold. The statement included recognition that U.S. economic growth had slowed in the fourth quarter, but the labor market remains strong. In addition, the Fed said that inflation target was not achieved, but would likely return to the Fed's target despite headwinds from lower oil prices and the strong dollar. We see this as reason for no Fed action in the coming months. So higher oil prices and solid earnings from Facebook, Under Armour, Caterpillar, and Harley Davidson are pushing stocks higher in early trading. WTI oil is gushing higher by $1.75 to $34 a barrel on the notion that production cuts may be coming in the near future. So it already mentioned bonds are having a tough time busting above near resistance, so clients should still be advised to lock.
Well, it's nice to know that
lock them if you got
that Facebook's leading the way, meaning we're all just clicking through our Facebook.
In other words, there's nothing real.
Yeah, there's nothing really happening.
We have nothing real to base. So it's all the unemployed people having free time to be on Facebook reading the ads. So the advertiser. So tell me how this works as a long-term strategy.
Okay.
Unemployed people or underemployed people watching Facebook have time to watch ads. So people spend money on ads. Advertisers spending increased money pushing Facebook's value up because there are more ads being run to people who
don't have
are unemployed and underemployed and can't buy what they're watching anyway. Yes. I can totally see where this financial crisis is
Scott,
all over and we're on the way out.
Scott, no, you're a sales guy. Does that make any sense to you?
Excuse me?
Does it make any sense to you?
The Facebook?
No, it doesn't. But I'm glad to know the political affiliation of your listening audience because I'm right with you guys.
Well, I don't know what here's the political affiliation we live by: crazy and not crazy. And sometimes things just sound crazy, and sometimes they don't. And I'm just saying, when Facebook's your leader, I'm saying
it's crazy.
I'm saying double down on batten the hatches is what I'm saying. Yeah, I'm saying when Facebook's your leader, batten the hatches. So we got 2 minutes left here before the break. Okay, so I got a whole pile of stuff here from when we get to Scott. But what do you got on the? Oh, you do have the MBS Highway. You brought it in.
I got the.
What's the last thing we got to say about interest rates in the market before we turn this show over to Scott?
Numbers.
Okay, go.
I just got by the numbers. I didn't read Barry today. Well, what is this? I had one on here. Joe, where is it? Oh, I know, retirement planning.
There we go.
We all should be, planning our retirement.
It's my Facebook stock.
You talk about that with your customers, how they're buying a home and whatever's part of their overall financial picture. There's 6 states that do not have a lottery. So you probably shouldn't move there because that's
my retirement plan.
That's going to mess up your retirement plan. Do not move to Alabama, Alaska, Hawaii, Mississippi, Nevada, or Utah.
You know what? I'm going to take one exception to that.
Okay.
Hawaii.
I'd forego the lottery if I could afford to live there.
In Hawaii, who cares?
If I could afford to live there, I'm moving. I don't care about the lottery. No, a trivia question for everybody. Okay, the first state lottery began in what state in 1964?
1964. The lottery began in Illinois.
New Jersey.
Nope. Scott?
No, I don't have a guess.
You're close, Jim. New Hampshire.
New Hampshire.
Oh, the Granite State. Boy, they do everything. They got the politics.
You gotta love those guys.
They are on the cusp of everything.
Do
you think Donald Trump's going to show up there again?
In New
Anybody
Hampshire?
make him mad? He's not coming to the Fox debate tonight.
No.
Don't make him mad. He's not going to come and talk to you if you make him mad.
I love that. That'll be our new diplomatic strategy.
Hopefully we haven't
made foreign policy.
Hopefully we haven't made Scott mad, and he'll be back.
All right, after the break, Scott Woodward from Radian Mortgage Insurance is the topic. After the break.
Right now, 32.
Here's Sean Hannity, weekday afternoons on Super Talk 1270.
I think I'm going to Kathmandu.
You know what they don't have in Kathmandu?
Lottery.
They don't have private mortgage insurance.
Oh, probably not.
Yeah. That's why they're all so happy there.
You are just trying to make our guest.
I know, he's cut me up already.
No, everybody knows that. That's the whole tongue in cheek. You know what, Scott,
Dave,
you're probably
Dave Floor, Joe Sheehan here.
Yeah, what you have to remember, Scott, is I did this big market presentation about, what was that now, 5 years ago?
You did a video.
It was about 5 or 6 years.
Yeah.
I did a video and it was called I Hate PMI, and I did all these presentations called I Hate PMI, and they were tongue in cheek and they were flip the script presentations. what we did is we got everybody there, and the whole presentation was about how to beat PMI, but really the presentation was about the value of private mortgage insurance, because as you're going to get into this, there's a lot of people who can't beat PMI, and there's a lot of people that when you really look at it don't want to when you understand it. And so after you started talking about, well, it's kind of one of those things like, you know what? Here's how you stay out of heaven. And then you start realizing, well, wait a minute, I don't want to put 20% down. I don't want to.
Yeah.
Well, then what are you saying? You must like PMI.
So the basics.
So anyway,
for
so
everybody. Private
we got
mortgage
Scott.
insurance.
We got Scott here. He's going to give us the lowdown. He's going to tell us stuff that you would never know about, that's important for the general public to know about MI companies and what they do and why they're valuable. So, Scott, go ahead and tell us a little bit about
So
yourself.
and then the basics of what is private mortgage insurance.
Yeah, so let's start out a little bit about you, Scott, and then we'll get into the basics of mortgage insurance.
Okay, well, I'm talking to you from St. Paul, Minnesota. I've been in the mortgage business. Well, it'll be 33 years this May, 2016.
Short timer.
What's that?
Short timer.
Short timer. That's right. I'd like to also let your listening audience know that we have a daughter that is a junior at NDSU. We're big Bison fans here in this household.
Woo!
And I'm looking forward to just participating in this conversation this morning, this early afternoon.
Well, give us tell us about PMI. Give us the basics. What's the basic things everybody needs to know?
Listening just a little bit, what you're saying is, everybody feels the way that you described earlier, but it's something. It's a necessary tool to allow people to, get into a home at an earlier point with less than 20% down, and with private mortgage insurance, you can go as low as 3% down to get yourself into a home. And there's really basically two buckets for getting into a home with a low down payment, and that's the Federal Housing Agency, or the FHA, which is a government-backed insured loan. Any one of these loans that have less than 20% down are, quote unquote, more risky, or they're at least evaluated as more risky. So they require to have insurance. So even though you're getting an FHA loan, there is going to be, MIP on it. There's going to be mortgage insurance on the FHA product. Now, what ends up happening with that is, in some of the benefits against a private mortgage insurance loan versus an FHA loan is that the MI is on that loan for the life of the loan. It doesn't come off on loan to values that are 90% and above. Whereas private mortgage insurance loan are for your non-government sponsored loans, where if you go to a Cornerstone and Joe's going to originate a loan, he's going to have to sell it off into a private investor, and if it's got less than 20%, they're going to need private mortgage insurance on it. The positive thing to that is that the MI can come off. There is a new law out now. It's the Homeowners Protection Act. It's called HOPA. And basically, all loans that have private mortgage insurance, even if your listening audience gets a loan with MI, even if they totally forget about it, once the loan balance falls below 78% or at 78% or below, it is a requirement by all the servicers or the person or the bank that's holding the loan. They have to stop the MI. And then the other thing that's a positive for private mortgage insurance is that if the borrower closes a loan at a higher, with a lower down payment, but they maybe put increased down payment down, and they get to an 80% of the value of the property, then they could also, at that point, petition the servicer, not Joe. They wouldn't go to Joe for this, but they would petition who's servicing loan, who they're making the monthly mortgage payment to, where they could request the removal of the MI. And typically, you'll need to provide a valuation of the property, an appraisal, And if they, and your payments are current, then in most cases the servicer will release the MI.
Do you have information about getting PMI released on your website?
I do.
Anywhere for the
and
consumer?
after this, Joe, I have a couple of nice little flyers that I could send over to you, and I also have like a little video clip that I'll pass over to you as well that you could forward on to your borrowers that actually they can go in and watch, and answer all the different questions about how mortgage insurance works against. Whether it's an FHA loan or a private mortgage insured loan, and the differences between the two.
Well, do you have that information on the Radian website?
It is on the Radian website. It is.
Where's that? Where can people find that if they want to go out there right now and look for it?
Yeah, if they go to radian.biz, and so it's Radian RADIAN.biz, and let me see exactly where that might be on there, but they could find it. But what I could do is I'll send you the flyer too. If they go to the Radian.biz, along the top there's going to be some headers there. Let's say lenders, servicers, homeowners, and if they click on the homeowners, the third one down, it's going to be Mortgage Insurance 101. So if you want to learn about what mortgage insurance is, we've got a little course there if you to educate yourself. And then the third one down is canceling mortgage insurance. And so they could see all the different things or the ways that I just described, how the MI can be removed.
No, Scott, I'll say, what we do at North Dakota Housing, we service our loans that we buy from the banks. And we have information on our website on how we look at when we can drop private MI. And what we do is somebody requests the 80%, like you were talking, they have to request that from us once they think they're at 80% based on the original value. Sometimes we'll require an appraisal, but most of the time, if they have been a good paying customer all the way through it, we will just check their tax records and see what do they have it valued at? Has it basically stayed the same or increased in value according to this, the county? And if they've been a good paying customer and there's never been any issues with them, that's probably enough for us right there to just drop it without having the cost of an appraisal be involved.
And that's a good point, David. And I just want to clarify to the listening audience. I mean, the evil private mortgage insurance. The private MI does not have a requirement for the amount of time that mortgage insurance needs to be on the loan. I mean, we don't have any seasoning requirements. We don't dictate how long it needs to be on. So now you have the law where once you hit 78% of the value, it automatically needs to come off. But if you close a loan and your servicer, like you just said, David, if you think that borrower is a good risk and you're happy with the loan, I mean, they could have that MI on there for a month, and they could, maybe get, win that lottery that you were talking about earlier, put that money down, and if you as the servicer of that loan deem them a good credit risk, and you just notified Radian, we'll drop the MI without any questions asked.
Yeah,
so we don't predicate how long it needs to be on the loan.
I think that's the most important part about understanding what it is that you guys do. Is what you do is you provide a service. You guys aren't out there making anybody buy private mortgage insurance. The private mortgage insurance companies aren't the ones who, and that's kind of funny how that works in the bank, because I'll tell you when I'm talking to my customers, they never blame me for them needing private mortgage insurance, which actually, and it isn't really me, but really it's Dave. I blame Dave.
Yeah, it is.
But really, it's the servicer. It's the investor. It's Fannie and Freddie. It's Fannie, Freddie. It's the bank. It's the servicers who say, here's your choice. You can have 20% down, or you have to insure us. And you guys are just the people who offer the insurance. This would be kind of like blaming State Farm for making you have car insurance.
Yeah.
Okay. So you go to your car lot, you buy a car, and the guy at the car lot says, well, before we can let you leave with the car, you have to have car insurance. And you go, what do you mean I have to have car insurance? You're going to make me have car insurance? Well, you can either have $1.5 million in cash to cover your liability of driving a car, or State Farm can insure you
Yeah.
for $1.5 million in liability.
Yeah.
What would you rather do? Well, I don't have $1.5 million in cash. Well, you don't get the car then.
Yeah. It's a choice.
Yeah.
It
So
You
does
wanna-
is anybody mad at their car insurance company for it? No, they're glad they're
Just
there.
the cost of it, maybe.
But they're glad they're there, that
Yes,
they provide a
absolutely,
service.
yeah.
You might complain about the price, but a lot of times the price is whose fault?
Yeah.
It's yours
Yeah.
based on your driving record.
Yeah,
And it's the
exactly.
same thing with PMI. They're providing a service.
That costs you based on how much you put down
Yeah.
for down payment. and what your
Otherwise, you
credit
could
score
not have
is.
the house. Oh, I don't have 20%. Well, then you can't have the house. Well, but here's another option.
Yeah.
So
That's what it is.
I think that that's important characterization is that you guys provide a
So
service. And,
we'll be going to break here, Scott, and we come back. Maybe talk a little bit about the different kinds of premiums you can pay for: lender paid,
Yeah,
borrower
break that
paid,
down for us.
single, monthly, all that good stuff.
Okay.
Okay.
all right, back after the break with Scott Woodruff from Radian. Private mortgage insurance.
She stood there bright as the sun on that California coast. He was a Midwestern boy on his own.
Right now, 32.
Mary Lou Henner, weekdays on Super Talk 1270.
It's one of my favorite Bob Seger songs.
Bruce Strut.
Nice. All right.
Okay, I got something a little
Well,
weird.
before
for you.
I want to go back and just correct one thing that Scott said, because in North Dakota there's a difference. In North Dakota though, if you qualify for any of the North Dakota housing programs, you can get in with a lot less than 3% down.
Yeah, actually, because if you use the START or DECA program,
You get the 3% as a down
Yep.
payment. You only need a $500 minimum
$500
investment,
minimum, yep.
which is a real deal.
And
Okay.
Scott, what does Radian require as a minimum amount? If somebody's using our down payment assistance programs, do you have a minimum you require?
Well, typically for mortgage insurance, it's a 3% minimum is what it is,
Yeah.
and that could and that's typically the lowest we can go, or the
Okay.
highest we can go.
But if they're using one of our assistance programs, you guys are okay with that, so they don't necessarily need the 3% out of their pocket.
exactly. Yeah, in fact, we could put your assistance on top of that and go to a combined loan to value of 105% of the value. So they could it dovetails in that. And what I'd also like to add to that is if the loan is insured with Radian, we are the only private mortgage insurer in the industry that actually provides what we call job loss protection. We call it Mortgage Assure. Joe's familiar with this, but basically it's at no additional cost to the borrower. There's no premium changes. There's no paperwork that's required. Joe doesn't have to do any paperwork. The borrower doesn't. Any loan that closes with Radian that has an L or above will automatically get this insurance, which protects the borrower. If they lose their job within the first 2 years from the date of closing, this insurance, at no cost to them, will pay up to $1,500 towards their first mortgage payment, up to 6 months and or $9,000. So it's just a bonus. It comes free. We're the only MI company that provides it. So if you are in one of these higher LTV type loans and you're working with Joe or Dave, make sure you say, hey, make sure you put my insurance with Radian so I can get that free Mortgage Assure.
Nice.
I like that sound of that too.
Yeah.
Yeah.
Well, I bet you
Be
really
an
like
investor.
the sound of that.
Yeah.
What's the biggest reason for default?
Yeah. Biggest reason for default? Job loss.
There you go.
Divorce. And spending too much money.
There you go.
Yeah.
So you had
So
something.
he's got one of them covered.
So
which we like.
you had something weird.
Well, I had
you
something
said.
weird. It just before we get started into different kinds of PMI. Okay. This came from a Kiplinger tax letter. Payments a woman got for agreeing to be faithful to her boyfriend are taxable. Okay. After dating for about a year, a couple pledged their fidelity to each other in writing. The agreement required him to pay her $400,000.
That's a gift.
Later, he accused her of cheating. They broke up and he sued her. He also filed a 1099 miscellaneous reporting the payment. A state court found that she defrauded him and required her to repay the $400,000, and to add insult to injury, the tax court says she owes tax on the amount. That's worse than PMI right there.
There you go. That's a lot worse than
That's
anything.
worse than PMI. Don't.
I can't believe a judge stood on that.
I don't know. That's weird.
That
But anyway,
too-
so we found something that's worse than PMI right there.
Absolutely.
Okay. Now, Scott.
Scott, tell us about the different kinds of private mortgage insurance.
Borrowers have options. Okay, they need to insure their loan because they're not putting 20% down, but there's some options on how they can do that.
Exactly. And so basically, just so they know that the less that they put down, the higher the premium is going to be. That's just, it's you have less skin in the game. So it just goes to say that the premium, regardless of the option, is going to be higher when you put less down. So a 3% down payment type loan is going to have the highest required insurance versus one that has you put 15% down. So anyway, but typically there's three options. The one that's used the most, probably is the most popular or easiest to understand, is the monthly. And basically, depending again on what your loan to value is when you close a loan, there'll be a percentage of coverage, and then there's a factor. And then what Joe will do is he'll take the loan amount and he'll multiply by that factor, divide it by 12, and he'll come up with a monthly mortgage insurance payment, which you pay, when you pay your mortgage, it's part of the mortgage payment. So you're paying it every single month individually as time goes on. Yep. There's two other options. There's one that's a little bit more complicated, but the ones that make it for purposes of the discussion, there's a lender-paid option, and then there's a borrower-paid option. So if somebody, let's say, their mom and dad, has, they're a little bit, they got some cash they want to contribute, and they want to, help their son or daughter get into a home, what they could do is they could, put money down so you could actually pay the mortgage insurance borrower paid up front in one lump sum. And then basically you insure the risk of the loan, and you provided you satisfied the need to cover the mortgage insurance. That's typically probably an option for a borrower that's going to be in the loan for more than just a few years. So if you're somebody that's coming in and out of a home, or you don't think it's going to be something that you're going to stay in that property for a long period of time, you're probably not, you may not want to consider that.
Can you get a refund on that? Say if I only
well,
live there for 5
okay.
years.
So now again, if there's two options there, so you have a refundable option and a non-refundable option. Okay. Now, mostly the industry uses a non-refundable option because it's cheaper. It's less expensive, so the premium, if you will, is going to be less on those. If they want a refund, then the premium will be higher. And then, of course, it's prorated based on the length of time that they're in or on the loan. They could get a refund. So it's kind of part of the whole consultation that Joe provides his borrowers as far as understanding their individual specific needs as they're having the conversation on financing the home. And then the other one would be lender paid. And what we could do there is when we say lender paid, the lender, Joe, let's just use Joe as an example, Cornerstone, whether the borrower pays that in the closing costs or Joe will factor that into the interest rate. So maybe the interest rate's a little bit higher on the loan, but then there's proceeds from the loan that Joe can then credit towards the mortgage insurance. And then when the loan closes, Cornerstone will just cut a check to Radian, and MI has been satisfied in that channel.
Right. The advantage to lender paid is that the rate will be higher. So let's say the rate is 1/8 or 1/4% higher to do lender paid insurance. But then what happens is under the current tax laws, interest is deductible. Mortgage insurance premiums haven't always been deductible. I don't know if they are right now. I can't remember.
No, they are. They actually are. Mortgage insurance. They just. But
it's always renewed on an extension, right? It's always. It's not like the. It's not permanent. It's not permanent. So one of the reasons to do lender paid is that it's paid for in your interest rate, which is deductible and has been, but that isn't guaranteed anymore either, as we know that's one that's been put up on the chopping block to get rid of a couple times now.
Yeah, and if you're not sure you're going to be deducting that you can't.
But they did just legislate that to continue. So I mean, at least for this year coming forward, unless there's another change, but the latest on that is it is still a tax deductible item. And you know what your listening audience should understand too on the lender pay. Maybe you've got a corporate client coming in and he's going to be or somebody that's in a situation where it's almost like when you buy a car. I mean, I want to spend this amount of money. What ends up happening with the lender paid too is the rate might be higher. So if you're looking for bragging rights at the water cooler, it's probably you're not going to have those. But what ends up happening is if you do a comparison against the lender paid, the actual payment that you're making on your mortgage each month, it's typically less than if you had a lower interest rate and then you added on the monthly payment on top of the the mortgage payment, the principal and interest payment. That total payment in most cases, in most scenarios, will be higher than if Joe kicks up the rate, pays your MI for you. Your total payment will be, in most cases, will be less, and so that's a good thing too.
Mm-hmm. Yeah,
so it can get you more property for your dollar.
The only question I had, Scott, is I thought under HOEPA we couldn't do non-refundables anymore.
Yeah, it gets a little gray there. I know that on the lender page, it's not counted in the QM, the quality mortgage regulations, because it's built into the interest rate and it's not part of it's not a line item for mortgage insurance.
But just charging a non-refundable upfront premium, I thought we couldn't do non-refundables and still have a qualified mortgage. And has the industry settled on what's considered life alone for that coverage as well? Because I know that was always one of the issues too.
I don't know if I have an answer to that, Joe.
No, I don't know that anybody does. I think that's one of those things where I think that's one of those great answers the CFPB has been great about not getting back to us on.
They've lacked guidance on that, which they seem to do.
Yeah. As long as you go life alone, you can do that. Okay, well, what's life alone? Yeah, like we said.
Life alone. Yeah.
Life alone.
We'll tell you when we see it.
Yeah. We'll tell you. We'll tell you when you did it wrong.
Yeah. Yeah.
I think that's kind of where we're at on that. So, hey.
Okay. So, Scott? What do you want to share with us when we come back from the break?
Yeah. Do you want to? Can you stick with us through the break into the next segment?
I mean, there's probably one other area I wanted to touch on. I mean, I definitely wanted to get that mortgage assure out, but there's another area that I want to probably just touch on that people may not know about. Private mortgage insurance versus a government-backed loan. So I could touch on something along those lines.
Well, and I'll tell you the great thing about this too is that in most of it works this way too. Is that the other thing too is when you don't even really know this is happening. The mortgage insurance companies pretty much just accept the lender approval of the loan according to the underwriting guidelines, and they just accept that and write it's really one of the easiest and maybe the easiest insurance you can ever get.
All right. So.
All right, after the break, more Scott Woodward from Radian.
Okay.
Private mortgage insurance.
And now the young monsieur and madame have rung the chapel bell. C'est la vie, say the old folks. It goes to show you never can tell.
Right now, 36.
Dave Ramsey is heard here. Super Talk 1270.
Call the customers and have them get in touch with you. Yeah. All right. Well, we were solving a world problem on the break. It's amazing what you run. It's amazing what you run into, and that's why it's so important. We got Scott here with us from Radian Mortgage Insurance, and like I said, mortgage insurance gets mischaracterized a lot on what it really is, and it's really a service that gives you an opportunity to do something you couldn't do on your own, and we were actually just talking about a service problem that had to do with insurance, not private mortgage insurance. But it's nice when people are a part of the solution, and private mortgage insurance is absolutely a part of the solution. And
okay, so this segment we want to talk. Scott, you had a couple of things you wanted to add about.
Yeah, just one other thing, and going and dovetailing into what Joe just said about the solution. And this is another thing to dispel the evilness of private mortgage insurance. If a borrower gets 2 or 3 payments.
Oh, I think we lost you there for a
minute. We lost you. We need you to re-say that. You cut out on us.
Okay, I'm sorry. I said, just saying what, continuing what Joe said about, the service that private mortgage insurance brings and to dispel the evilness of private mortgage insurance. one of the things that your listening audience needs to understand is, if they do fall behind on the loan, the servicer, nobody really wants the property back. And what the MI company will do on behalf of the borrower, that's the last. That's really the last solution as far as foreclosing on the property. That's where the mortgage insurance plays and will help the servicer reduce their losses. But before that happens, with an MI company, with Radian, we have a workout department, and we'll actually work individually, specifically with the borrower, to help come up with solutions. So we'll actually work as an intermediary, like just say almost like an attorney between the borrower and the lender, and figure out ways where we can mitigate the damage, if you will, and come up with solutions to keep the borrower in the home. And that might be making partial claims to the servicer while the borrower gets back on their feet. That might mean recasting the loan, which means we'll re-amortize it so that maybe they have to extend the term of the loan, but they'll reduce the monthly payments to help the borrower get in there. Every avenue will be explored. When the loan's insured with Radian, our workout people will actually work with the borrower specifically and act as the go-between between the borrower and their specific circumstance and the servicer, and come up with as many solutions as conceivably possible to keep them into the property. And I think that's something that people don't really understand. They just think we're just going to cut us out and move us into the street. That's not what the MI company is all about. We want to keep you in the home, and we'll figure out ways to work with you and your lender to make that, accomplish that goal. And that's really the last thing I wanted to bring across to your listening audience today.
Yeah, and you're absolutely right, Scott. We service our loans at North Dakota Housing, and we don't want the house back. We want the person to stay in their house and make their payments, and you guys don't want to have to pay a claim to us. And that's the bottom line, and we'll do what we can to help somebody out. So,
well, I think one of the other things too is that this is rarely. One of the things I was always told in my background in financial industries is one of the things that we always believed is insurance companies don't lose money.
Yeah.
Insurance companies never lose money, but in the financial crisis, there were a lot of big insurance companies brought to their knees.
Yeah.
From this, where they really did deliver and pay on the claims. And you look at it just from a macro perspective, Scott, and you can speak to this. We got a few minutes left, but without some of the claims being paid into the banks that were dealing with loss in the servicing, the insurance claims paid by the MI companies really held a lot of banks open. Without insurance on these mortgages, you'd have had more bank collapses.
Yeah, you would have. Yeah, definitely.
Exactly.
Now, Scott, let's talk about, we have our North Dakota Housing Conference coming up in February 16th and 17th, and Radian is going to have a presentation on the afternoon of Tuesday. What can you tell us about that? What are we going to?
Well, I know that we're going to be a gold sponsor at the event. We're actually looking forward to being a part of that. We always look forward to the housing conference. It's very well attended. I know that we're going to be giving a session for the audience that wants to participate in selling in a purchase market. It's geared towards originators to help them, accumulate more skills to, go out and work with whether it's financial planners, realtors in the marketplace to help them, build their business, if you will, to do more purchase type loans versus just refinance loans.
Yeah, and it's important. I know Joe does this, and he preaches it in his shop. Is that you've got to understand how the mortgage that they want to buy a house or they want to refinance, how that fits into their overall financial picture, right, Joe?
That's the most important thing.
It's important, and just like you were talking about, okay, do I put more money down to avoid PMI or to lessen my premium? I don't have 20% down, but I got enough for 10, or I got enough for 15. does that make sense to put as much as I can down, or do I put less down? What's the better options? And the loan officer has to understand how that fits into that person's financial picture.
My actual method is that I actually base the first idea on the payment the customer can afford.
Yeah.
What's the payment you believe you can afford in your budget? And once I have that payment, I try to structure everything backwards from there. Mm-hmm. And I actually encourage people to put the least amount of down they can. And the reason why, and so I do use a lot of mortgage insurance options. Yeah. And the reason why is because to me, in your financial life, what always causes a financial crisis is when people don't have access to cash.
Yeah.
And so if you have money down and you put all that money into your house, I got to pay a bank to get that money back now because I got to do a home equity loan.
Right.
Well, they don't do home equity loans for free.
Yeah.
Now I got to pay you to get my money back.
Yeah.
So I've actually encouraged low money down options based around the payment and your comfort options, because one of my little remember, I'm an etch a sketch in an iPad world, Scott. Mm-hmm. So I got to keep my financial rules simple. So one of the financial rules I taught my clients over the years is that cash equals choices. And if you have cash, you have choices.
Yeah, you do.
And so I've encouraged people to use low money down options, use private mortgage insurance, use MI options, because that helps keep cash on your side. So if something goes wrong, then you don't have to get a loan from the bank. You don't have to. You have options to fix things yourself. And the other thing is you have more negotiating power with cash sometimes.
Yeah, so that's what the session the rating is going to be doing, is going to be talk about how the loan officers can expand their business basically by understanding all this stuff, and like you said, Scott, work with financial planners and their realtors, et cetera. Correct?
Exactly.
Yeah. Okay. Well, what else can we talk about? Evil PMI. I know. I mean,
Well, let's talk about.
We both know Scott.
Let's talk
he's
about
an evil-looking guy.
Let's talk about why we know when something is really good, it comes from the devil, like bacon.
Okay.
You know why. Now you know why. When Moses was coming down the mountain, he had to put bacon in there because there's no way he couldn't trust him for 40 days up there. He came back down and the whole place was a mess. Well, if they'd had bacon, are you kidding me?
Some bacon. Yeah. They would have been happy.
They'd have been. Oh man.
Yeah.
I mean, so and that's and what did Jesus do when he threw people out? He put them in the pigs, and the pigs went in the bacon. I'm telling you, bacon. So we had a little contest one night. We're out all probably consuming one or two adult beverages.
This sounds
nothing like I would do. Anyway, it was just a rare occasion.
Okay.
So we were sitting there trying to come up, like a group of 12 people, trying to come up with something that bacon doesn't go with.
Oh, this is a good topic for discussion.
We couldn't find anything. Ice cream, chocolate,
yes.
Bacon goes with everything.
We were having a conversation with my daughter and my wife, and I were having a conversation about chocolate. What would chocolate not be good on? And it's same thing. It's bacon. What is bacon not good? Scott, do you have anything that bacon wouldn't go with?
I'm a big fan of bacon, so I can't think of anything, to be honest with you.
We found one thing that might be bacon neutral.
Yeah.
Lutefisk.
Lutefisk. Oh, there we go.
Oh,
Jim, do you think of anything over there?
Bacon neutral?
Or that bacon doesn't go with.
Bacon would be good with lefse.
Bacon would crumble it up with a little butter.
Oh.
Throw it. Heat it.
Bam.
Maybe put a little Jack.
Bam!
Or a little Harvard.
You get a little
Havarti?
emerald on that thing.
Shredded Havarti?
Yeah.
Oh, my God.
You get a little emerald on that.
Oh, geez. There's nothing.
You just gave me an idea for I got lefts in my freezer.
There's nothing that bacon doesn't make better.
I have lefts in my freezer. I am having bacon with my lefts.
Next time I have you know what I'm doing? I'm putting bacon in every first aid kit.
There we go.
There's nothing it doesn't make better. Here's a bandage.
I've got a bullet wound. Here's some bacon.
Here's some bacon. You know what? I feel better already.
Ah.
You
can put it on the wound or eat it, and you're going to be better.
And chocolate. Now I got to think about what doesn't chocolate go on
with? Yeah.
Shoe leather. It goes on shoe leather, for crying out loud.
It probably could. Yeah.
Yeah. Anyway.
Yeah. So that's Yuri that we had a similar conversation with her.
You know what? That's what you have to do on the North Dakota Housing Finance Agency Conference survey.
What we find?
Bonus question.
We need to have
bonus
a broad
question.
Survey.
Bonus question.
Yep.
What doesn't go with bacon?
Yep. We should have that everywhere. Realtor convention, everything. They should ask that question just so we can see what people think.
Mango.
Mango and bacon?
I think you put a little brown sugar on it.
Oh, that's
you
good.
heat it up.
It's
I
gonna
think
be
it's
good.
I
like breakfast.
That sounds like breakfast.
what doesn't go with
Okay.
That's
Well,
how
Scott,
that's how you know Lucifer invented
Scott, radian.biz, right? That's if people want to learn about MI, they need to go to radian.biz, correct?
They can go to radian.biz, exactly.
Click on homeowners and go from there.
it. Hey, thanks for
Yep.
coming on the show, Scott. Look forward to seeing you here in a few weeks.
Yep.
We'll go from there. Thank Radian for letting you come on. We appreciate it.
Yeah.